Washington thought it had locked in a $20 billion lifeline for Argentina, until the biggest U.S. banks quietly walked out of the room and left Scott Bessent with nothing but a collapsing plan and a deadline no one wanted to face. The shock hadn't even settled when a second rupture hit. Nvidia's CEO admitted the world's fastest-growing AI market had vanished to zero, wiping out the demand the company built its future on. Two events, hours apart, both cutting through America's financial core, one in sovereign credit, one in advanced chips, and together they signal a shift no one in Washington or Silicon Valley was prepared to confront. The consequence hit Washington within minutes. Instead of the anticipated $40 billion structure combining Treasury support with private lending, the emerging proposal had shrunk to a $5 billion repo facility that would barely allow Argentina to meet a single January obligation. According to Financial Times reporting earlier this month, JP Morgan, Bank of America, and Citigroup were increasingly reluctant to extend unsecured multi-year financing without concrete collateral, and internal assessments suggested Argentina could not provide it without triggering domestic backlash. Their retreat placed the entire weight of the plan on the U.S. government, raising concerns that the stabilization effort had shifted from financial engineering to geopolitical leverage. The strategic implication formed quickly. Reuters, citing officials familiar with the negotiations, reported that Bessent's goal was to prevent Argentina from deepening its reliance on Beijing's liquidity networks. The concern was structural. China had already renewed a multi-billion yuan swap line with Argentina in the spring, and IMF statistics show the country's foreign exchange reserves rely heavily on that facility to smooth import flows and debt service. Analysts warned that if U.S. banks refused to participate, the vacuum would push Buenos Aires further toward yuan financing, accelerating a regional shift away from the dollar. A second pressure point emerged in the Midwest, where farmers saw the bailout not as geopolitical strategy, but as a replay of an earlier crisis. USDA data from the previous decade showed how sharply Chinese soybean imports from the United States fell during earlier trade tensions, while Argentina expanded supply at lower export tax rates. The memory still stings. Lower-priced Argentine shipments absorbed demand that U.S. producers assumed was theirs, and many see the proposed bailout as Washington underwriting a competitor that had already taken market share. That fear is not emotional, it is economic. Farm cooperatives in Iowa and Illinois told the Wall Street Journal last week they expect any stabilization of Argentina's financial position to make its agricultural exports even more competitive. The political cost rose faster than the financial one. The timing of U.S. assistance appeared to align too closely with Argentina's electoral calendar, and several analysts quoted in New York Times coverage earlier this month said the package risked being interpreted as direct intervention. Bessent rejected that framing, pointing instead to decades of Treasury involvement in regional stabilization efforts through the Exchange Stabilization Fund. He described the initiative in publicly available remarks as a defensive maneuver aimed at preserving long-term influence. His argument follows a clear logic: geopolitical power is cheaper to maintain with liquidity than with force. The underlying data supports that logic. China's credit expansion into Latin America has grown rapidly, with Reuters citing nearly $10 billion in new commitments announced at the China-CELAC Forum this year. These flows typically move faster than Western lending and are often paired with yuan-based settlement options, which IMF tables show have expanded across the region since last year. The dynamic is simple. The more local governments transact in yuan, the more they diversify reserves away from the dollar. In regions where liquidity is scarce, the fastest provider gains influence. The consequence is not abstract. If Argentina deepens its reliance on yuan liquidity at a moment of financial fragility, the effect could cascade. Emerging market economists quoted by Bloomberg last month warned that multi-currency financing structures tend to harden over time because switching costs grow as payment systems, banking protocols, and trade invoicing recalibrate. A short-term liquidity choice becomes a long-term monetary alignment. For the United States, the fear is that alignment could pull South America into Beijing's financial sphere for a generation. While Washington wrestled with that shift, a parallel crisis was unfolding inside the world's most valuable semiconductor company. Nvidia's valuation, already unprecedented, faced a new threat after its CEO Jensen Huang warned in recent remarks covered by the Wall Street Journal that China sales could fall to zero for the coming quarters. The implications were far wider than a temporary hit to revenue. Industry analysts interviewed by Reuters earlier this week noted that China represents one of the fastest-growing markets for AI accelerators, and Huang's own estimate placed near-term demand around $50 billion, rising toward as much as $200 billion by decade's end. That scale is not speculative. It appears in market forecasts and procurement patterns published in Bloomberg's semiconductor coverage. The risk is structural. If U.S. export controls remain tight, Nvidia's most advanced GPUs cannot legally reach China, and lower-tier variants may fail to meet demand for frontier training tasks. The neutral question is not whether Nvidia loses a market, but how much of its long-term pricing power depends on global scale. Several investment researchers cited by the Financial Times have already revised future revenue projections downward based on the assumption that China will remain restricted. The pressure intensified when new technical claims emerged from Beijing. Earlier this month, Chinese researchers affiliated with Peking University published results suggesting their new analog in-memory computing prototype achieved throughput several orders of magnitude above Nvidia's H100 architecture while using dramatically less power. Reuters, summarizing the findings, noted that the system performed calculations within memory arrays instead of shuttling data across buses, circumventing the bottlenecks that limit traditional digital processors. The researchers reported energy efficiency improvements approaching 100-fold under certain workloads, with accuracy levels comparable to commercial systems. The significance lies in the workloads these analog chips target. Training large-scale models requires enormous compute density and power, and modern data centers already strain electrical grids in multiple countries. Earlier this year, the Financial Times reported that data center expansions by major cloud providers were fueling electricity shortages in several U.S. regions, prompting utilities to accelerate new infrastructure investments. If China's analog systems can deliver high-throughput performance with minimal power draw, they could build AI clusters that scale faster and cheaper than those dependent on digital GPUs. A further consequence emerges when these developments coincide with market valuations. According to recent Bloomberg data, Nvidia's market capitalization surged past $5 trillion on expectations of unstoppable global demand for its accelerators. But if one of its largest markets goes dark and a technological competitor emerges simultaneously, the valuation becomes exposed to multiple compression triggers. Bank of England officials, in public speeches covered by the Financial Times last month, warned that equity markets tied to AI infrastructure exhibit signs of speculative concentration, echoing concerns raised by Goldman Sachs leadership earlier this year about overheating in technology multiples. A quiet tension spread through investment desks because the numbers align in a way that suggests fragility. The S&P 500's price-earnings ratio has climbed toward levels associated with prior bubbles, and nearly all large-cap tech firms depend on aggressive growth assumptions in their forward projections. Large asset managers interviewed by Reuters noted that if China becomes fully self-reliant in high-performance AI chips, U.S. companies would lose not only revenue, but network dominance. CUDA's software moat matters less if hardware alternatives gain traction in the world's largest economy. The United States has used export controls to slow China's ability to train frontier models and to protect national security interests. But if China develops domestic alternatives that outperform restricted products, the leverage dissipates. Official Chinese investment plans published in state-linked economic bulletins and summarized by Bloomberg last week indicate multi-billion-dollar commitments to scale analog in-memory design. If that scaling succeeds, Beijing gains a pathway to AI capability independent of United States hardware, weakening Washington's bargaining power. The interplay between these crises produces a single pattern: financial withdrawal, technological divergence, and geopolitical recalibration, each reinforce the others. When banks retreat from Bessent's plan, the vacuum strengthens China's role in regional liquidity. When China accelerates chip innovation, Nvidia's valuation becomes vulnerable. And when United States farmers perceive foreign competitors gaining advantage, domestic political resistance to foreign rescue packages intensifies, reducing Washington's flexibility. A brief synthesis clarifies the direction. Liquidity shapes alliances, and technology shapes leverage. Combined, they influence how power is exercised without force. The next tension emerges when examining Argentina's debt timeline. According to bond market data cited by the Wall Street Journal recently, the country faces several clustered maturities early next year, and missing any of them could destabilize local markets already weakened by inflation. If the United States provides only a small repo line instead of a full credit package, Argentina may be forced to activate more yuan-based mechanisms, accelerating de-dollarization at precisely the moment United States officials fear it most. A quieter signal emerged from Europe. Analysts quoted in Financial Times coverage earlier this week said the rapid rise of China's lending footprint in Latin America mirrors patterns seen previously in parts of Africa, where swift deployment of credit created long-term system dependence. They warned that once payment networks adapt to yuan settlement, reversing course requires not just political will, but new infrastructure, which takes years to build. So there's a notable shift in Nvidia's own projections. Jensen Huang actually stated publicly that the company is now forecasting zero China revenue for at least 2 consecutive quarters. That kind of admission really sets a precedent, a global tech giant, basically preparing for the complete loss of one of its fastest growing markets. Investment researchers, as quoted by Bloomberg, called this shift extraordinary, since, well, very few trillion-dollar companies have ever just written off an entire major market voluntarily, even when facing serious regulatory pressure. Now, why does this matter? Well, it becomes clear with one further link. China's AI ambitions don't slow down when U.S. companies exit. In fact, they accelerate. Several Chinese provinces have released investment roadmaps this year that allocate billions to new data center construction, and Reuters confirmed that multiple state-backed labs are already testing analog accelerator clusters specifically designed to bypass U.S. technology altogether. Every new deployment like this reduces Nvidia's relevance in a region where, honestly, it once assumed long-term growth. As these developments converge, a new uncertainty opens. If United States banks continue to step back from emerging market risk, and China extends liquidity through swap lines, the balance of monetary influence shifts. If Nvidia loses access to the world's largest economy, while Chinese researchers push analog breakthroughs, technological leadership shifts. If South American governments adopt yuan-based lending, while United States farmers oppose interventions that stabilize competitors, domestic political support for United States influence erodes. The next development intensified the pressure. Market strategists told the Wall Street Journal last week that defensive positioning in equities is increasing, with rotation away from overextended AI leaders. Asset managers cite stretched valuations, declining breadth, and tighter financial conditions as early warning signs. These trends matter because Nvidia's valuation depends on sustained enthusiasm, and, enthusiasm weakens when uncertainty rises. Amid these fractures, one institutional reality stands out. The United States retains the deepest capital markets in the world, and the dollar remains the primary reserve currency. But IMF data in its latest quarterly tables shows that the share of global reserves held in dollars has been drifting downward gradually for several years. The shift is slow but persistent, and China's expansion of yuan-based financing accelerates the trend at the margins. The consequence flows back to Argentina. If the country increasingly settles trade or debt obligations in yuan, its need for dollar reserves diminishes. That reduction weakens United States leverage at a moment when Washington is trying to maintain influence. Bessent's strategy aimed to counter that drift by offering liquidity faster than Beijing. But, without the bank's participation, the Treasury stands alone on the front line, and unilateral support can become politically unsustainable. If United States banks decline to back a crucial stabilization plan, if China develops hardware that threatens the core product of America's most valuable company, and if one of the largest emerging markets increasingly turns to yuan credit, which pillar of United States power absorbs the impact first? No forecasts answer it cleanly. The data only sharpens the uncertainty. Please like and subscribe. Leave your thoughts in the comments. Your support helps us grow. Thank you.